It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
I think what's driving these large growth figures is probably mainly the government's 5% deposit scheme, which is obviously allowing first-time buyers to get on the market easier. It's lowering the bottom rung of the housing ladder a little bit for first-time buyers.
And that is Graham Cooke on the Real Estate Breakfast, here 7 days a week across Australia, talking property news and information from Darwin to Canberra and from Rockhampton to Perth. We are streaming right now on multiple platforms, including Spotify and Apple Podcasts. Well, new data from Domain's September quarter rent report. Now, that shows rental yields are surging outside the big cities. Regional hotspots like Darwin leads the country. Units are outperforming houses in every capital city, offering better returns for investors. You investors, you know exactly where those hotspots are. As I mentioned, Darwin dominates with yields up to 8.73%, while Melbourne, Perth and Western Sydney follow close behind. The key drivers are affordability and consistent demand, so probably no surprise there, particularly in mining hubs, and that is just out from Domain. Well, it's a Friday, 7th of November, as we look towards another weekend of property, and what a week it has been. Homeowners may have missed out on a rate cut this week, but there's still some good news. What is the good news? Well, that is that the banks are now in a full-blown cashback war. Finder.com.au data. Now, that tells us a dozen lenders are offering up to $5,000 in cash or 300,000 Qantas Points to borrowers who refinance, often without changing rates or terms. Rising competition in the loan market has pushed banks to fight harder for customers, meaning now could be the right time for homeowners to shop around. I always say it's always a good time to be doing that. And let's right now take you to Melbourne and catch up with Graham Cooke from Finder. And good morning, Graham. Welcome back to the Real Estate Breakfast. As I mentioned, mortgage holders, they didn't get that relief that they were hoping for on Tuesday, but these banks, as per you guys reporting, are starting to intensify their fighting for customers.
Yes, indeed. So you normally get 2 or 3 of these kind of cashback offers in the market at any given time historically, but the volume of them in the market seems to be increasing dramatically recently. In fact, at last count at Finder, we found 11 different home loans with cashback offers and 5 different home loans with frequent flyer point offers, including the one that's been making the headlines recently from CBA. Their online loan gives you 300,000 Qantas points on sign-up, which is interesting because that's higher than the actual Qantas home loan, which only gives you 200,000. So it definitely seems that banks are increasingly offering extra kind of bells and whistles on top of just a low interest rate to try and attract customers in this increasingly competitive market.
Yes, so let's just run through some of these banks. I see that Bank Vic leads with up to that $5,000 for refinances at 5.35%. And you've got some other banks in on the action as well that are showing up.
We do indeed. So the range of banks that these are on offer from go across the market, from AMP to ME Bank, Greater Bank, IMB Bank, Bank Vic, as you mentioned, Newcastle, Regional Bank Australia, a couple of credit unions as well, Bank of Queensland. You can find the full list on Finder. The cashback offers range from about $2,000 to about $5,000. And the home loan interest rates kind of vary across that range too. In terms of frequent flyer points, we're seeing offers from 100,000 to 300,000. Now, interesting, the CBA 300,000 Qantas Points loan, just trying to compare that to the cashback. The value of your Qantas Points depends on how you use them. But if you can use those points for classic flights, which are difficult to book, but if you can do it, those 300,000 points are going to be worth about $6,000. So that will actually give you a better return than any of the cashback offers. And if you can use them for business class flights or upgrades, you can get even more. So if you fly a lot, that could be the one to look at.
So there's some great news there for refinancing, but the experts are saying these incentives may not last long. So it's kind of a cheery at the moment, but they may very well be withdrawn, early next year? Who knows?
Yeah, they kind of come onto the market and disappear on the market with no notice. So if you see one that's really attractive to you, it's probably worth putting some effort into getting it quickly. The thing to note, though, is I wouldn't take any of these on board unless you're paying no higher an interest rate than you're currently paying, because over the long course of the loan, that's the most important figure. But I have heard a lot of Finder colleagues, for example, have switched to home loan to the same interest rate just to get the cashback offer. And I'm talking to colleagues who are doing that every couple of years. So, if you want a couple of grand into your bank account every year or so, this could be one potential way to do it.
I remember last year we were talking about this whole sort of refinancing, because so many people, and you'd know this at Finder, they set and forget. But I think probably post-COVID, well, it took them a long, long time actually post-COVID to then start looking around and going, well, hang on, there are better terms and conditions out there. I need to change banks. And that whole education piece, it did take some time to sort of filter through.
It is, yeah. In the industry, we call that the lazy tax. So people tend to sign up, especially with something like a mortgage, which is the biggest expense of your whole life, and just keep going with the same bank and forget. And they tend to prize loyalty with an individual bank. But in this market, loyalty generally doesn't pay, which is why it's important at least every couple of years to look at the rate you're paying, use a comparison service to see what the lowest rates in the market are, and see if you could be getting a better deal. The last research we did looking at the average home loan rate in the market versus the lowest rate found about a 40 basis point difference. That's nearly 2 cash rate cuts equivalent that you could be giving yourself if you do find a better price loan than the one you're on.
Yeah, and if you're one of these people that think, yeah, I want to remain loyal to my bank. My bank has been fantastic to me over the last 10, 20 years, whatever the case may be. Get out of that way of thinking, because your bank is not loyal to you. You've got to look after number one. And again, that loyalty factor, it's a bit of a mystifying thing how people sort of get sucked down the rabbit hole of being loyal to their bank.
Yeah, I think it's an old-fashioned thing as well. So we tend to find with Finder consumers, those above 40 tend to be, and I'd be in that group, tend to be more loyal and stick with the same bank. And those under 40 tend to be far more likely to switch, and therefore far more likely to get the lowest rate. And this doesn't just apply to home loans, credit cards, personal loans, even broadband packages, phone deals, all that kind of stuff. Generally, the early bird gets the worm.
Indeed. All right. So it just needs to be a bit of an attitudinal change. We are talking to Graham Cooke from Finder this morning. And when we come back, we'll talk about something else from Finder. That is the property price forecast for next year. A little bit of a prediction right across some different markets. And we'll also look at a factor that is actually causing the prices to be driven up. All of that coming after this.
Eager to expand your property expertise? Enhance your real estate know-how with us.
Let's go off to Veronica Morgan from Good Deeds, who is here. I'm going to test your knowledge here because I reckon you'd probably do quite well with this, because it's probably going back 1995. Maybe that was around when you first bought your property. Maybe it was later. But Sydney in 1995, house price, what do you reckon the median was in Sydney in 1995?
I'm totally taking a stab because this was before I got into real estate as a career, but I had bought my first property, I think, in 1995. So it just shows my age there. I'm going to take a stab. I'm going to think it's in the 200s somewhere.
Yeah, I knew that you were going to get very close to that. 197 grand. 1995, that was the median house price. Melbourne, you want to take a stab at that?
Well, I know it's going to be less than Sydney, so I'm going to guess in the 160s.
Yeah, that was quite interesting. 85 grand for a house.
No way. Wow.
Yeah, 85 grand.
Oh, wow.
Brisbane was 127,000. Take a stab at Adelaide.
Hey, so hang on. You're telling me Brisbane in 1995 was about 50% higher than Melbourne?
Yeah, apparently so. Yeah.
I have not actually gone back that far in time. That really does surprise me. Are we talking houses or dwellings?
Houses. These are houses. Yeah.
I find that hard to believe, but, hey, I haven't seen it. I haven't gone that far back and split capital cities. But look, Adelaide, I would have to think was less than Melbourne, so maybe that's in the 60s?
81,000.
Wow.
Every week, unravel the real estate market. to help guide your real estate journey. It's the Real Estate Podcast.
It is a Real Estate Friday. Good luck tomorrow and on Sunday if you are out looking at property, especially when it comes to those auctions. Graham is with us from Finder this morning, and we're going to look at the property price forecast that you guys have got out, predicting into next year. So what are you predicting?
Indeed. So this is from the most recent RBA survey of 40 economists across academia and industry that we do every month. In Finder, we asked them what their predictions are for the property market in Australia in 2026. And in increasing order of percentage growth across the capitals, we have Adelaide 3.9%, Perth is 4%, Brisbane 4.8%, Sydney 5.6%, and topping the list of potential growth next year is Melbourne with 5.8% average across the panel. I think this is interesting. One of the, even though the economic signs are a bit mixed at the moment, especially showing that we haven't got a cash rate increase, inflation is going up, employment's going up. I think what's driving these large growth figures is probably mainly the government's 5% deposit scheme, which is obviously allowing first-time buyers to get on the market easier. It's lowering the bottom rung of the housing ladder a little bit for first-time buyers, which is one of the reasons that economists are predicting solid growth over the next year, even among economic headwinds per se.
So with those economists that you were talking to, what about GOP politics in terms of what is potentially on the horizon heading into 2026? Because, it just takes one event and the trickle-down effect can happen quite quickly.
Yeah, so this is interesting. There's quite a few factors at play in the RBA decision. Basically, the RBA right now are trying to decide which is more important, the inflation rate or the unemployment rate. So the unemployment went up. That led economists to start saying the RBA will probably cut the cash rate in November because they would do that to stimulate the economy. Then the inflation data came out. Now, the government, the RBA, are trying to keep the inflation between 2 and 3%. That's their target bracket. It hit as low as 2.1 when they started to, cut the cash rate, but it started to creep up, and what made them stop was basically the inflation rate hit 3.2, so right above that threshold, which means they're holding and waiting for the inflation to come down. Now, economists on our panel are still saying they think that will happen. They're still talking about cash rate cuts coming next year in the kind of first quarter. We've seen predictions all the way as late as September, though, but they're still saying a cash rate cut is on the way. But as you mentioned, international affairs are kind of all over the place at the moment. Nobody saw COVID coming, nobody saw the war in Ukraine coming, so it's difficult to know what factors will come into play between now and mid next year.
All right, Graham, we'll leave it there. You have yourself a fantastic weekend, a great Friday, and once again, thanks for coming back on to the Real Estate Breakfast.
Thanks, Craig. Always a pleasure.
Every morning from 6, we bring you the latest real estate news with diverse perspectives from leading industry experts. Your real estate journey starts here.
5-10 years ago, selling a 2-bedroom unit, which was fairly close to the city, it would typically be bought by the same profile, an investor who wanted to sit on that property for some time and get a really solid yield. But now we're finding more and more that the price point is critical, and it's at the same price point that a first home buyer can afford.
You might have 3 or 4 families collectively saying, hey, this is a really good scenario. What does everybody think about this? We can purchase this block, we can do this, that, and the other. And they seem to have an appetite for this.
They do. We're definitely seeing a little bit more of that in the market, particularly in that development market. So if we've got a large property that can perhaps fit 2 or 3 properties, we might see a syndicate arrangement where people agree to buy the property together. One of those parties might be a developer themselves, so they can factor in sort of the pricing and ability to do a bit of that within their own company.
We connect you to the best real estate information across Australia. The Real Estate Podcast.